So the Doji is the most commonly known candlestick signal. And a Doji is where it opens and closes at the same time frame, or at the same place during the day. A small trading range is a Doji star. If the price of the movement is big during the day and it closes right where it opened, it's called a long-legged Doji. Down here, if it opens at the top of the trading range and heads down and comes back and closes at the top, it's a dragonfly Doji because it looks like a dragonfly. And the Japanese rice traders say a gravestone Doji is where the bulls or the warriors come out of camp, they go into battle, they get beaten back into camp by the end of the day, leaving their dead all over the field, thus the gravestone Doji. Also, a derivative of the Doji is called a spinning top. It's where the body is a little bit bigger, but it looks like a spinning top. But there's one common element in all those signals. There's indecision going on between the bulls and the bears. And that is very important for when we're taking a look at what's transpiring during a price trend. So the Doji rules that the Japanese rice traders, and this is a nice thing that they did, over 400 years, the Japanese rice traders not only observed the signals, but they also told you what the psychology was that created those signals. So first of all, they added some rules. They said if you see a Doji at the top, it's time to sell. If you see a Doji at the bottom, you need further bullish confirmation to tell you that the trend has reversed. Always pay heed whenever you see a Doji. And then this is the most important one right here, is the trend will usually move in the direction of how they open it after a Doji. Now with that information there, the fourth one, that's where you make a ton of money with high probability trades. So up here, we see a Doji at the top. Now, on my charts, as you can see, there's not a whole heck of a lot of indicators on there. What we have on our charts is the red line is the 200-day simple moving average. The blue line is the 50-day simple moving average. The gray line is the 20-day simple moving average. The reason for that is, for these to be on the charts, is that every major money manager around the world uses those moving averages to make the decisions for their portfolio. The advantage we have with candlestick analysis is we can see exactly what's going on in investor sentiment at those important technical levels. Now this one, the black one, is one that if you don't get anything out of this session, you want to remember this. This is called the T-line, the 8 exponential moving average. And a very simple rule, if you see a candlestick buy signal and a close above the T-line, you can stay in that trade as long as you don't see a candlestick sell signal and a close back below the T-line. You need that combination. Now there's a caveat to that the further away you move from the T-line, the higher the probability you're going to come back and test it. So that makes it very simple that if you see a nice uptrend, the Japanese rice traders have just put common sense and investment perspectives into a graphic formation, and it basically says, where do most people buy? They buy exuberantly at the top. And where do most people sell? They panic sell at the bottom. So if we see a situation where we're in an uptrend, an uptrend, an uptrend, and then we see a sell signal away from the T-line, the probabilities are extremely strong that there's probably going to be at least a reversal to come back and test the T-line. So when it does test it, we have no idea whether it's going to continue down or whether it's going to turn around and head back up, which is a signal that we will, or a pattern we'll recognize. All right, so if you see a gap up in an overbought condition, again, moving away from the T-line, it's probably time to start taking profits. Now, this has always been my fear. What do most people fear when they're investing? They've got all sorts of phobias. Mine was, boy, I'm making money off of this, this price move. I'm buying golf clubs. I want to buy a new car. And boy, it looks like it's time to sell, but I would sure look stupid if I sold here and this thing kept skyrocketing without me. Boy, would I look stupid. But then I realized, or finally came to the conclusion, that the Japanese rice traders, that developed this did not become wealthy from this training or this trading method. They became legendarily wealthy. They were the powerhouse in Japan for hundreds of years. So it came to the situation, and I'm kind of pushing something around here, that if you see a doji at the top, and again, my top is when stochastics are in the overbought condition. And my stochastic settings are 12, 3, 3. So if I see a candlestick sell signal in an overbought condition, and it's moved away from the T line, I'm starting to take profits. Now, if I see a long-legged doji, remember, a doji means indecision. A long-legged doji means much greater indecision. It's time to take profits, and it's very simple. The Japanese rice traders say if they open this price lower the next day, close out the position. That tells you the bears are now taking control. Okay, if it gaps up, if you see a gap up in an overbought condition, that basically confirms that perception of what's going on in investor sentiment. There's exuberant buying going on. If it does a doji, then it's time to watch for a lower open. So if you see a doji in an overbought condition and they open it lower the next day, they have one simple rule: sell immediately.